Hi everyone. I've done a few videos this morning on commercial property purchases, and I thought I'd finish off the morning with a residential scenario. So often I get clients come to me and talk about, buying another property. So they own one property and they want to buy another. They don't have any savings, but they've got a really good equity position. And what I mean by that is they've created value or equity, a difference between what they owe and what their property, their home, is worth. So here's a very simple example of how we can leverage that to purchase another property without having any cash available. The big asterisk on this one before I go any further is this is subject to servicing or borrowing capacity. Okay, so in this case, we are assuming that my clients can service $2.985 million of debt for this example. Okay, so that's the big asterisk. But let's get into it. So my clients own 123 Smith Street, Brisbane for $2 million, and they only owe $1.1 million against it. They bought it 7 years ago. They've built equity. They've paid down their loan. Their loan to value ratio is a mere 55%. Now, the neighbors are selling their home. It's 125 Smith Street for $1.8 million, and my clients really want to buy it. But again, they've got no cash, no savings. How do they do it? Well, this is how they do it. We're going to use the equity available in their property at 125 Smith Street to complete the purchase, 123 Smith Street to complete the purchase of their neighbour, 125 Smith Street. I should have maybe chosen different numbers here. So if we're buying for $1.8 million, we also need to come up with another $85,000 in stamp duty for an investment property of that value. And the bank will happily lend you 80% of the purchase price without triggering lender's mortgage insurance. So 80% of $1.8 million, the purchase price, is $1.440. However, the purchase price plus stamps minus what the bank's willing to give you leaves a funding gap of $445,000. So what do? We actually grab this $445,000 out against our home because we only owe 1.1 against a $2 million home. We can borrow up to 80% against it, so $1.6 million, without triggering lender's mortgage insurance. So this is what the debt structure looks like. Loan 1 is their existing home loan at 123 Smith Street for $1.1 million. That's this loan here, hasn't changed. Loan 2 is what we call an equity strip or cash out for investment purchase or purpose. So it's still secured against 123 Smith Street, and we're not cross-collateralizing these here, okay? These are individual loans and individual securities. But we're pulling out $445,000 against 123 Smith Street to use as a contribution towards our new property. So in total, we now owe $1.545 million against our home at 123 Smith Street, which is still below an 80% loan to value ratio, so tick, play on. And then our third loan is this one up here. It's the 80% loan against our investment property for $1.440. So what do we end up with? We end up with 3 loans instead of 1. Your existing home loan, principal and interest 30 years at an owner-occupied rate. And then we get these 2 investment loans. One secured against your home, one's an 80% loan against the new property. And those 2 are investment rates. They could be on interest only, subject to servicing. And they have been used to fully debt fund the purchase of our new investment property, get all those negative gearing benefits from the debt as well, because the loan purpose is investment. And we haven't had to tip any cash towards the purchase either. So, a bit to unpack there, but this is a very, very popular way of using leveraging equity available in our homes to fund the purchase or contribute towards the purchase of another property. Of course, subject to being able to service all of that debt, but something I thought I'd quickly explain to you because it's a very popular topic and I get asked about it a lot. If you want to chat more about it, give me a call.